Good morning, Wichita. I'd like to thank Wichita State University and the Center for Economic Development and Business Research for having me here today. I think the timing of this Economic Outlook Conference couldn't be better. It's hard to believe, but we're now 6 years into this economic expansion. The U.S. labor market is making visible progress. Consumer spending is once again leading U.S. economic growth. The housing market is on the mend. In fact, U.S. economic conditions have improved so much, the Federal Reserve is contemplating raising U.S. interest rates for the first time in 9 years. I think a whole generation of bankers have grown up not even seeing an interest rate hike. But before I give you my 2 cents on maybe where we are and maybe where we're headed going forward, I'd love to poll this audience. It's not often an economist gets almost 1,000 people to do a straw poll, so I'm going to take advantage of this. How many people think the Federal Reserve is going to raise interest rates this year? It's pretty close, but I'd say almost 50%, or maybe a little bit over 50%. And so that's higher than the market's forecast right now. If you look at the Fed funds futures markets, they're not predicting a rate hike this year. So the traders are basically calling the Federal Reserve's bluff. They don't think Yellen has the guts to go forward with a rate hike this year. I'll tell you my view in a few moments, but I think that sets us up for an interesting discussion this morning on where we may be headed. So we're in a pretty good place here in the United States. I'm feeling, we're 6 years into the expansion. The average economic recovery in the United States in the post-war period is only about 7.5 years. So we're getting kind of in the middle age or even a little long in the tooth in terms of economic growth. But we still think there's some room for the economy to run, and I'll talk a little bit about that. But there are emerging boogeymen in the closet that we need to talk about. The first is the global economy. The global economy, as the IMF and others have noted, is deteriorating. In fact, just yesterday, Christine Lagarde, the head of the International Monetary Fund, my former employer, once again is talking about cutting their forecast for 2016 for the global economy. And they've been slashing their forecast for the global economy all year. And they think this year is going to be worse for the global economy than last year. I'd say global uncertainty right now is at its highest level really since the Great Recession in 2008. So I'm going to talk a little bit about how that plays into our U.S. economic outlook. China is certainly slowing faster than authorities there have planned. The fear is China's in for a hard landing. In fact, China's policymakers right now appear to be a little bit in panic mode. They've cut their currency. They've devalued their currency, the Chinese yuan, for the first time in 20 years. And they've had trouble stabilizing it. They've been intervening in the markets ever since August 11th when they devalued to try to support their currency to make sure it doesn't devalue too much. We've seen a stock market bubble collapse in China. That's wiped out over $5 trillion US in stock market wealth there. Because we're a bank, we watch very closely what's going on in the financial markets. Global financial markets are distressed. Financial conditions have tightened over the past month and a half. For example, corporate bond spreads are widening, and it's raising the borrowing costs for many U.S. businesses, despite the fact that 10-year Treasury yields continue to decline. The U.S. stock market, I don't know how you're enjoying the stock market volatility we're having, but the volatility is the highest we've seen in the U.S. market since 2011. A lot of our clients and customers are asking me, what does this mean? Should I be cashing out, putting money on the sidelines? Where is the stock market going from here? All I can tell you is that the global stock market has already lost about almost $14 trillion in wealth just in the past month and a half alone. So today I only have about 30 minutes, but I'll try to make sense of all these conflicting signals we're seeing from both the U.S. and global economies and what it might mean for the U.S. outlook, monetary policy, and interest rates over the next year. Let's turn first to the global economy. You can see there very uneven growth rates. Globally, we're seeing a little bit of a slowdown this year from last year, and we don't expect much of a bounce in global growth rates in 2016. The real weakness is coming from the emerging markets. Remember the BRICS that Goldman Sachs talked about: Brazil, Russia, India, China, and South Africa? Well, Brazil and Russia are in recession, as is South Africa. So 3 out of the 5 BRICS, or the major emerging market economies, are in recession. China is slowing down rapidly, and it's really only India that's outlook has held up, and their growth rate is being maintained at around 7%. We are seeing a little bit of a pickup in growth in the developed world. The U.S. has been kind of the leading economy there, though our expectations for growth next year have diminished. We think the headwinds from the rising dollar, the global economy, will continue to weigh on U.S. exports and business investment. So we do think U.S. growth will slow a bit next year to around 2.4%. So that's a little bit better than where we've been over the past 6 years. On average, the U.S. economy has grown in this expansion only 2.1. So, it's not the acceleration that we were anticipating maybe 6 to 12 months ago, but it does look like what's going right here in the U.S. economy is going to be enough to offset those headwinds we're seeing from abroad. Though Japan's economy is slowing, we've cut our forecast there, and Latin America is in recession. And it's really the drop in commodity prices, oil, and the slowdown in China that's having an impact there. So I'll just say, for the headlines today, we recently cut our forecast for China. We were below the Chinese government's target of 7% this year. We've now cut our forecast to 6.5% for China this year and 6% for next year, which would be well below what the authorities were hoping for and guiding for this year. And I'll talk a little bit about what's going on there. So let's start, I think, with China. That's the big concern. That's part of what's really been driving the volatility in the stock market here in the United States. China's economy is weak, no doubt about it. We don't have a great read on China's economy because we don't have a lot of good economic statistics coming from that country. When I used to work at the International Monetary Fund in my past life, it was well known that a lot of the big headline statistics out of China were somewhat massaged. Some of these, it was kind of a bottom-up technique. They went around to the local governments and asked them, okay, what did your economy grow in your region? And of course, their bonuses and their promotions depended on hitting their growth targets. And so they would always revise higher or increase their estimates. So we try to look at some hard data. We look at things like freight traffic, electricity demand, and loan growth. Those are things that are a little bit harder for the authorities in China to mask and to massage. And so I lead off with that statistic from China. This is freight traffic in China. It's a very good indicator of current economic activity. And you can see that we're seeing declines now in Chinese freight traffic of around 14% year over year, which is a lot deeper than what we saw even during the Great Recession in 2008. So when you take all the measures like electricity demand, freight traffic, and loan growth, the Chinese economy looks like it's probably really growing at only around 5%, or maybe even a little bit under that right now. So a 6.5% growth rate would require some lift in Chinese growth before the end of the year. China's big problem is they're really trying to transition their economy from an export-driven, production-driven, business investment-driven economy to a consumer-led economy, very similar to what you see in the developed world. And so, as you can see from this chart on Chinese retail sales, they're not doing a real good job of it. Retail sales growth is on a pretty solid downtrend over the past 7 years. And there's no real sign here, especially with the stock market bubble collapse, the Chinese are going to see a recovery in their consumer spending growth anytime soon. In fact, the risk is that Chinese retail sales growth continues to slow. I don't know how much of you invest in China. A lot of foreigners can't invest directly in the Chinese stock market. But we do know it has a big impact on global markets and confidence. I really wanted to share with you this slide this morning. This is coming from China's internal market. It's called the China Next Index, which is very similar to the US NASDAQ. And it's a lot of these .com companies that have gone public in China. That's the index that they're listed on in China. And this is a measure of stock market valuation. We call it a PE ratio, price to earnings ratio. So the higher the number here, the more expensive Chinese stocks are. And you can see that just this year, since the beginning of the year, the stock valuations in China's markets exploded. We went to 130 on the PE ratio on this particular stock market index. Just to give you an idea of where the US market is, and a lot of people think the US market is overvalued, the PE ratio on the S&P 500 is somewhere in the 15 range, 15. And so that's the extent of the overvaluation that we saw in the Chinese stock market. Now, we've already seen a huge sell-off in China. Stocks have dropped 50%. We've wiped out $5 trillion in stock market wealth in about a month and a half. So where do we go from here? Well, the Chinese authorities have intervened dramatically into the stock market. They're arresting people that are selling stocks right now in China. They're intervening. They've set up a fund in China over $500 billion to buy stocks. And they call them the national team. If you ever watch CNBC, you'll hear them talking about that from time to time. And they go in and prop up the stock market when they think it's weak or needs to. So they've kind of stabilized the market right now at about where it began the year. But we still are in the early stages of seeing the economic fallout of that. And by no means do we know if this experiment's going to work. If the confidence continues to erode, the authorities are going to continue to have to ramp up their rescue of the equity markets. I know it's turned off a lot of foreign investors to the Chinese market, and you're seeing collateral damage across Asia, including the Hong Kong Stock Exchange, where a lot of U.S. investors invest. So I'm not projecting a hard landing in China at this point, though we do think growth is going to come in a lot slower than what the authorities thought maybe 6 or 12 months ago. They are going to do whatever it takes to try to stabilize the economy, just as our Federal Reserve did in 2008. So I do think the Chinese Central Bank, the People's Bank of China, will be intervening. We'll see more and more rate cuts coming from China to try to stabilize their economy. And they have the room to do that. They're not at zero interest rates like we have been in the United States since 2008. So they have some more room to loosen monetary policy there, and that's what we do expect they will continue to do. The central authorities are also ramping up in terms of their government spending, and they're going back to their old bag of tricks. So they're going to spend a lot more on high-speed rail again. They're doing more investment projects. Economists worry about that because we already know there's a lot of overinvestment. I toured China, major cities, back when I was working for Wells Fargo at the time in 2012, and there were a lot of ghost towns then, and it's gotten much worse since. So there's by no means any guarantee here that China's going to be able to achieve what they want to achieve. The problem I see is psychological. I'm not a psychologist, I'm an economist, but we do take psychology into consideration, especially when financial markets are involved. And what I worry about is the Chinese people have 100% belief that their government can manage things. You go there and consistently people tell you, oh yes, there's bubbles, there's overheating in certain markets, but the government will have our back. The government's going to bail us out like they're bailing out the stock market. And to some extent that's true. They have a tremendous amount of ability to do that. The problem is if people lose confidence in that, if the crisis develops to a point where the Chinese authorities do lose control. In that case, I think the psychology switches on a dime. It's a nonlinear event, and you see a lot of fallout hitting the global economy and the U.S. economy as well. But you need to have that contagion to really cause a recession here in the United States or globally. China's trade balance with the U.S., while they're running a huge surplus with us, we don't export enough to China to really markedly change our outlook for the U.S. economy. On the trade side, they're just not a big enough player. So yeah, it could cut 2 or 3 tenths off of U.S. growth next year, but the consumer is the main game here in the United States, and the consumer is still looking pretty rock solid. and I'll talk a little bit about that. So that's China. The Eurozone has been another area of concern for economists over the last few years. We've gone through a sovereign debt crisis. A Greek exit was in the papers in June and July. We now have a new program for Greece. And the Eurozone economy is actually in a pretty good spot right now. They've actually seen an acceleration in their economy despite all the negative headlines coming out of Greece and other countries. So if you look at a lot of the purchasing manager indexes in the Eurozone, they've actually improved throughout the summer. And we think they're on target to hit about 1.4% growth this year, which is going to be some of the best growth the Eurozone has seen in some time. The real concern is next year and their exposure to Germany, to China. We're already seeing some weakness in business confidence in Germany. It's been dropping for the last 6 months. So we do think maybe some of the best news for the Eurozone may be behind us. So the global economy is certainly a concern. What worries me the most about the Eurozone is where they are in terms of their unemployment rates. They're back to where the U.S. was in 2009. In fact, the unemployment rates across the Eurozone are higher than they were at the end of the Great Recession. So they've made no progress in the labor market, not like us, where we went from a 10% unemployment rate down to 5.1 last month. You can see in Greece, the unemployment rate is already still 25%. You look at youth unemployment, it's 40%. So we're talking about Great Depression levels of unemployment. And so if the Eurozone economy does fall off the rails and the global economy goes into recession, they don't have a lot of backstop here. And the misery would be very significant, and the social unrest that could develop certainly is still in play. So Eurozone, we might not have heard the last of it. I think we're going to continue to see the Eurozone in the papers as a potential downside risk. So let me switch gears a little bit and talk about what that means for the U.S. economy. So the economy's been evolving this year pretty much as we expected. We expected this would be the year for the housing market to rebound, the consumer to get back on track and lead the U.S. economic economy. And that certainly has been the case. And it's really been driven by an improvement in the U.S. labor market. So despite these downside risks from abroad, you still have a Federal Reserve that's looking at raising interest rates because of where we are in terms of the labor market. Now, the Fed has a dual mandate. One is full employment. The other is stable prices. And I'll talk a little bit of prices in a moment. But on the labor market side, at least, the U.S. economy is already about where the Fed wants it to be. And there's no real sign here that we're going to deviate much from that course. How good has the labor market been? Well, I think this gives you a pretty good overview of where we've been over the last decade. We lost 8.7 million jobs during the Great Recession in the United States. We've now finally recreated about 12.6 million of those jobs. We created 3.1 million jobs last year alone. We think we'll create about 2.8 million this year. Now, we get a big payroll report tomorrow, and we're still forecasting 205,000 jobs created last month. We think the U.S. unemployment rate will hold steady at 5.1%. So there's no real sign here that the labor market, at least as yet, feeling a huge impact from what's going on from abroad. And that's really due to the service sector. The service jobs are growing stronger. The manufacturing jobs, that's where we've got some issues, and we're starting to see more job loss there. In fact, about a third of all industrial production sectors are losing jobs now. And that's just in a small subsectors of the in manufacturing space. But beyond that, it's pretty broad-based job growth. So I don't know how many of you have millennials at home or young folks that have been living in your basement for the last 6 years, but I think it's time for you to tell them and show them that, hey, there are jobs being created. It's time to get out there and start looking for a job and maybe even build a career. So where are the jobs being created? If you're a young person, there might be some people here from Wichita State University that are looking at the labor market and thinking about where they might want to look for jobs. This might give you some idea of where all the new jobs are coming from. So I told you we created about 12.6 million jobs over the past 6 years. About 2/3 of those jobs are coming from only 3 sectors: professional and business services, which is a hodgepodge of kind of low-wage administrative support type jobs, accounting type jobs, And then some of them are high-wage technology, management, engineering type positions. So you get about, and it's almost a 50-50 split there. The other jobs are coming from retail trade, wholesale trade and transportation as the economy has lifted. And then the third sector is healthcare. Education and healthcare has been the third sector, and it's really healthcare that's driving the job growth. And it's the aging demographics, the baby boom generation aging. We knew this was going to be a sector. In fact, healthcare hasn't really seen a recession at all, and really never saw any slowdown in job growth from the Great Recession. So why is the Fed thinking about raising rates given this uncertain global environment, the financial volatility we're seeing? Well, it's really the fact that from the Fed's way of measuring it, the unemployment rate is really back to what most economists would consider full employment. Now, you might not feel like that today, but because there's so many people who have exited the labor force. You know, there's about 93 million Americans that are not in the labor force today, and that number has gone up by tens of millions since the Great Recession started. So economists have been debating, are these people gone for good? Are they going to be coming back into the labor force now that the unemployment rate is down and job growth is picking up and wages are starting to show a little bit of life, signs of life? We don't think so. I think a lot of the people that exited the labor force are probably going to be out for good, the vast majority of them. A lot of them took early retirement. They were baby boomers that just won't be coming back. A lot of them just have, their skills have degraded and they don't see the need. I think there's a lot of also dual income households where, you know, it just doesn't make sense for one of the spouses to work and raise a child. So some of these factors are all playing in to this lower unemployment rate. So this is at a point, we're at an inflection point where if the unemployment rate continues to drop, which we think it will over the next 6 quarters, we're going to start to see some upward pressure on wages. I think that's going to be good for the average American. We're going to see rising real incomes and somewhat better job growth and wage growth going forward. But that also signals to businesses, hey, my labor costs are going up and I better start to contain costs. So that's why the stock market might be getting a little bit nervous right now. This is usually a sign that the expansion is getting into its middle ages or maybe even a little bit past middle age. So that's something to keep an eye on as we go forward here. But this is certainly an environment where maybe the Federal Reserve shouldn't be still at zero in terms of U.S. interest rates. So why we're still fairly optimistic about our prospects over the next 6 quarters is really the strength of the U.S. consumer. The consumer really has almost everything going for them right now. Not only are we seeing a strengthening labor market and wage growth, but because gasoline and inflation rates are falling, consumer spending is being lifted. And you can see that in this chart here. Real personal incomes are growing at around a 4% pace right now, a little bit above that last month. And consumer spending is rising. And we're seeing some of the best growth in consumer spending we've seen in this expansion. And consumer spending is still 68% of our economy. So just a 1 or 2 tenths improvement there really goes a long way. So we think that can be sustained at least over the next 2 or 3 quarters. We're forecasting 3.5% consumer spending growth this quarter, 3.3% next quarter, probably into the 3s at the early part of 2016. So this is what's going to drive our growth over the next 3 or 4 quarters. You can see that on the retail gasoline price side. How many people look at the gasoline prices every time they come into work every morning? I'm in the Bay Area. We're still looking at almost $4 a gallon or a little over $4 a gallon for a gallon of gas there, but it's down about $1 from where it was a year ago. So that's money in people's pockets. We think that's going to add about $150 billion to consumer spending over the next 2 years. And so we're still seeing the benefits of that, and it's also helping to push down our inflation rate, which right now is helping on the spending side. And despite the stock market volatility, household wealth is at new record highs. We just got some recent data on that. And you subtract out inflation, we're still much wealthier today than we were even at the peak before the Great Recession hit. In fact, we've rebuilt our stock market wealth by over $20 trillion since the bottom of the stock market in the second quarter of 2009. So we know from our econometric studies that every $1 of stock market wealth raises U.S. spending over the next 2 years by about 2 cents. That doesn't sound like a lot of money, but when you're talking about $20 trillion of new wealth created, that adds up to some real spending power. So, and on top of that, households have been paying down debt. So all this consumer deleveraging we've seen, mortgage debt has actually declined. Debt to income ratios are back to 2002 levels. So a lot of the metrics we look at, especially with low interest rates still in place, suggest to us that the consumer has some room to grow here. Stock market volatility is a concern. People look at that. Right now, we do know it's having some impact on confidence, though we're getting some mixed signals there. The stock market volatility is the worst we've seen since 2011. And we are seeing a hit to the University of Michigan Consumer Sentiment Index. We've actually wiped out a lot of the gains and confidence we had so far this year. And that's really due to the stock market effect. Because when you look at the Conference Board's measure of consumer confidence, that just hit a new high, or almost a new record high for this expansion last month. So we're getting different signals. So consumer right now feels pretty good about the labor market, wage growth, current conditions. They're worried about the future, and they obviously don't like what's going on in the stock market. So where does that leave us? Well, I think it still leaves us with a pretty decent consumer spending trajectory going forward, but maybe not as strong as what we've had over the last couple of quarters. And then I turn to the housing market. You know, the housing market was the epicenter of the Great Recession and the financial bubble we had in mortgage lending. And we're really seeing some progress. The housing market really bottomed in 2012, and we continue to see improvement there. We did have a slowdown in housing last year, and that was really related to the spike in mortgage rates. I don't know if you remember, but Bernanke uttered the word, he had the taper tantrum in the bond market, and that really slowed down the housing market last year. We even saw some period of home price declines. But that's really behind us now. Because of the improving labor market, we're actually seeing an increase in households. I think a lot of those millennials are leaving people's basements, and they're actually starting to have jobs and starting to buy homes. And you're seeing that reflected in housing demand. So if you look at home builder confidence with low mortgage rates still in place, I think I looked at the mortgage rates last week. They were at 3.85 on the 30-year mortgage rate still. And I'm sitting here at 4%. Maybe I should refinance again. So we're seeing a lot of that improvement. And you're really seeing it reflect. And this is the bedrock of housing demand. It's household formation. And this we get from the Census Bureau. And historically, the U.S. economy has created about 1 to 1.5 million new households every year. These are young folks, you know, going out, starting a new home, or going out on their own and starting a new household. But over the last 12 months, the U.S. economy has created almost 2.3 million new households, one of the stronger than historical averages. And this is what's really been driving some of the optimism we're seeing in the housing market. So strong housing market, or fairly strong housing market, strong consumer, good labor market. What keeps me up at night? Well, we are seeing some emerging headwinds. The U.S. dollar is certainly not helping things. The U.S. dollar has appreciated about 20% since July of last year on a trade-weighted basis against our major trading partners. From the bottom, it's up about 34%. So that's almost like manufacturers raising their export prices by 20 to 35%. That's a big hit for manufacturers to take, and we do think we're still in the early stages of seeing the negative impacts from that. And we're already seeing that showing up in new order flows. This is a leading indicator of business investment in the United States, and so the business investment environment has weakened. We've actually reduced our forecast for 2016 on the business investment front, and really it's a lot of that's being the headwinds from the strong dollar and what we're seeing in commodity and oil prices in the energy services sector. And in fact, we've had 6 months now of contraction in industrial production. 6 of the past 8 months, we've seen negative numbers in industrial production. A lot of that's coming from the mining industry, oil and gas, and you can see the recession there in the industrial production measures. So what does the Fed do, taking all this into consideration? Well, you're really seeing a split right now in the FOMC committee. You've got a lot of people that are looking at the labor market saying, hey, things are pretty good, let's raise interest rates. Job openings, for example, last month were the highest we've seen in more than 15 years of collecting this data, 5.8 million jobs. Inflation is quite low, though, and so you got the doves on the committee saying, hey, we don't see any inflation until maybe 2018 or beyond. So what do we do with that? Well, the markets are pretty much agreeing with the doves right now. The inflation expectations over the next 10 years in the bond markets are extremely low, back to 2011 levels, back when the Fed launched Operation Twist. So there is some belief here that the Fed might actually have to go back and relaunch some stimulus programs as a result of the low inflation rates we're seeing. The other thing I'm a little concerned about is corporate bond spreads. Despite the fact that bond yields are moving down, I think this morning the 10-year was at 2.04 or 2.03, corporate bond yields are rising, and that's because credit risk spreads are rising for both BAA and high-yield bonds. So that suggests to me that, hey, markets are getting a little more nervous about credit risk going forward. So putting it all together here, they're pulling me off the stage, but we do expect one rate hike, a token rate hike in December from the Fed. That's been our forecast for some time, partly because the Fed's already got a lot of credibility on the line, and they're anxious to really try this thing, see if they can raise interest rates. Next year, interest rate hikes, we've got 4 in our baseline forecast. I'm thinking about taking 1 out, partly because of the weakness in the global economy. So while we still have an upward trend in interest rates, it's going to be very, very gradual. It's going to be a crawl to a very great extent. If you look at what the markets are forecasting, they think there's only going to be 2 rate hikes by the end of next year. So they're really calling the Fed's bluff. They don't believe what the Fed's been saying, that, hey, we're going to be raising rates. So putting it all together here, the U.S. outlook is pretty good. I think the third quarter, we're going to see more of a hit on the trade side than what we have here on these slides. So we might actually slow down to 2.1% in the third quarter, but we're still looking at about 2.4% for GDP growth this year. So thank you. I hope you enjoyed this, and I hope this helps fuel discussion for the rest of the conference.